Hello everybody, this is Devin of Defcon Economics back with another video, in fact episode number 11, entitled What is the COMEX? Simplified and Explained. We are going to do our best to just stay at a good clip, go over definitions, data, and at the end take a look at what happens when things maybe go not the way that they were intended. So this video will be solely educational, dedicated to discussing the definitions of the COMEX, futures contracts, the role of banks in the futures market, and perhaps some things that the regulators such as Bart Chilton here saw during his time at the CFTC that maybe will make you think a little. So this video is dedicated to the Wall Street Silverbacks or Wall Street Silver Forum as well. I put a question out on that forum and just got a ton of responses and great ideas for great videos. So I will be going and looking for the silverback who gave me the idea for this video, and I will be specifically thanking you and posting this video and commenting your name so you can take a look and tell me what you think I need to do. So without any further ado, let's get straight into it, guys. All right, remember also to like, comment, and subscribe now without any further ado. So here we are at Investopedia.com, my personal favorite source for just breaking down complex financial and market and economic topics for both myself and you guys, and I thought it did a great job. Again, this is by Will Kenton, and it was updated August 28th, 2020. And let's just go ahead and dive right in. What is COMEX? COMEX is the primary futures and options market for trading metals such as gold, silver, copper, and aluminum. Fairly simple. Formerly known as the Commodity Exchange Incorporated, COMEX merged with the New York Mercantile Exchange, NYMEX, in 1994 and became the division responsible for trading metals. Key takeaways. COMEX is the world's largest futures and options trading for metals. It is a division of the Chicago Mercantile Exchange, or CME. Metals futures are mostly used for hedging and are not typically delivered upon. The COMEX does not supply metals, instead acting as an intermediary. Okay, so there's a super quick breakdown. The COMEX is the world's largest futures and options trading for metals. It is a division of the Chicago Mercantile Exchange, or the CME group. Typically, the metals aren't delivered upon, and the COMEX doesn't supply the metals. They act as an intermediary, setting up the buy and sell orders for futures contracts. And don't you worry if you don't know what that is. We'll get into that right after we are done defining the COMEX in full. So now over here to Shift Gold. If you are a Wall Street Silver Forum member and you don't like him, we'll just set that aside for a quick minute and do a quick bit of reading. What is the COMEX? The COMEX, or CME Group, is a global derivatives market that allows for trading in futures contracts. They allow two parties, long and short, to speculate or hedge in specific commodity markets and guarantee the transaction in the process. The majority of gold and silver is traded in paper form on the COMEX within the futures market rather than in the physical market. And down below, it just discusses the more intricate details. I won't get into that so we can keep this video as short as possible. But basically, it's the same thing Investopedia told you. Now we have two separate definitions kind of giving us an idea, but just to really drive it home, let's do a third one. This is the CME Group themselves, the COMEX. CME Group is the world's leading and most diverse derivatives marketplace made up of four exchanges: CME, CBOT, NYMEX, and COMEX. Each exchange offers a wide range of global benchmarks across all major asset classes. COMEX, a designated contract market offering products subject to COMEX rules and regulations, joined CME Group with NYMEX in 2008. The merger expanded our suite of metals products to include several global benchmarks in precious, base, and ferrous metals. Okay, there we go. Three different, quick, simple, easy definitions of the COMEX. They just handle the futures market. They don't supply or deliver metals. Apparently, they just handle the futures market itself. All right, onward and upward. This is Investopedia futures contract. Again, I really enjoy Investopedia. Great place to simplify things. So down here, What is a futures contract? A futures contract is a legal agreement to buy or sell a particular commodity asset or security at a predetermined price at a specified time in the future. So corn, oil, soybeans, you set a contract that decides the time and the date, and you can buy or sell these contracts through the COMEX. Okay. Futures contracts are standardized for quality and quantity to facilitate trading on a futures exchange. So they have standards to make sure that it's kind of a similar. You want if you're buying corn, you want to make sure it's all good corn, not crap corn, right? So they have a standard for quality and quantity to facilitate that. The buyer of a futures contract is taking on the obligation to buy and receive the underlying asset when the futures contract expires. So there's something called the expiration date, and if by that time you haven't already bought what it is that you wanted to buy, you have to either buy it or roll over the contract into the next month. Don't worry about that. We'll talk a little bit about that in the future. Okay, so basically a futures contract is just the legal agreement to buy or sell something physical in the future. Futures contracts are standardized for the quality and quantity to facilitate the trading on a futures exchange, such as the COMEX. Okay, so it's basically just an agreement between two parties to buy or sell something in the future, hence futures contract. All right, let's move over here. Oh, get rid of that. Let's move over here where we're going to watch a short sub 5-minute video that will give you a visual on the futures market. Okay.
A $3 box of corn cereal stays at roughly the same price day to day and week to week. But corn prices can change daily, sometimes by a few cents, sometimes by a lot more. Why does the cost of processed foods generally stay quite stable, even though the crops that go into them have prices that fluctuate? It's partly thanks to the futures market. The futures market allows the people who sell and buy large quantities of corn to insulate you, the consumer, from those changes without going out of business themselves. Let's meet our corn producer, this farmer. Of course, she's always looking to sell her corn at a high price. And on the other side, our corn user, this cereal company, is always looking to buy corn at a low price. Now, the farmer has a little bit of a problem because her whole crop gets harvested at once. Lots and lots of farmers will be harvesting at the same time, and the huge supply can send the price falling. And even though that price might be appealing to the company that makes cereal from corn, it doesn't want to purchase all of its corn at once because, among other reasons, it would have to pay to store it. But it's fortunate that corn can be stored because that means it can be sold and bought throughout the year. And this is where the futures market fits in. Buyers and sellers move bushels around in the market, though actual corn rarely changes hands. Instead of buying and selling corn, the farmer and cereal maker buy and sell contracts. Now we're getting closer to peace of mind for both sides because a futures contract provides a hedge against a change in the price. This way, neither side is stuck with only whatever the market price is when they want to buy or sell. These contracts can be made at any time, even before the farmer plants the corn. She'll use the futures market to sell some of her anticipated crop on a certain date in the future. Of course, she's not going to sell all of her corn on that contract. Just enough corn to reassure her that a low price at harvest won't ruin her business. The contract provides that security. The cereal company uses the same market to buy bushels. Their contract protects against a high price later. Contracts will gain or lose money in the futures market. If the price goes high, the farmer loses money on that futures contract because she's stuck with it. But that's okay, because now she can sell the rest of her corn, what wasn't in that contract, at the higher price. That offsets her loss in the futures market. If, at harvest time, the price of corn is low, well, that's exactly why she entered the futures market. The low price means her contract makes money, so that profit shields her from the sting of the low price she'll get for the bushels she sells now. The corn cereal company doesn't like those higher prices, and that's why they have a futures contract. They make money on it and can use that profit to cover the higher price of the corn they now need to buy. The futures market serves as a risk management tool. It doesn't maximize profit. Instead, it focuses on balance. And in this way, it keeps your cereal from breaking your weekly shopping budget.
Okay, so there was a sub 5-minute quick visual explainer on the futures market using corn as an example, because while corn is a storable good, it is also a perishable good, and therefore, relatively speaking, I'm not saying futures markets are good, but it somewhat makes sense why one would use the futures market, and one could maybe now understand what they are used for. Okay, so a futures contract is a legal agreement to buy or sell a particular commodity, asset, or a security at a predetermined price at a specified time in the future. And now we have a visual that kind of explains that and goes along with it. And I would argue there's some things in there that maybe aren't 100% absolutely factually correct, but nonetheless, it's a great visual explainer. Now, we're going to move right on over to sifma.org, where this was a study they did on the role of banks in physical commodities, as you can see here. Now, we're not going to go down into the study itself because that would make this video probably an hour. We're just going to read a short bit from this so you understand why banks get involved, at least from a what I will call mainstream perspective. Here we go. This study explains and illustrates the important business role that banks play in the commodity sectors of our economy. We highlight the size and significance of these sectors and review their business value chains. We demonstrate how the role of financial intermediaries in physical commodities is beneficial in providing businesses access to capital and related risk management, e.g. hedging services. And we won't go much further, but there you go. The banks are involved in the COMEX futures contract hedging services, as we can see here, and these authors conducted interviews and all sorts of good stuff, and you can read this study again at sifma.org, the role of banks in physical commodities, to get a more in-depth view of that. But I just wanted to show you guys that yes, the banks are basically the intermediaries within the COMEX market itself, and they handle most of the futures market, both creation and trade. So now let's go right over here to the CFTC, or the Commodity Futures Trading Commission. These people are responsible for regulating and overseeing the commodity futures market, or the COMEX, for example. So let's just read from them what their mission statement is. The mission of the Commodity Futures Trading Commission is to promote the integrity, resilience, and vibrancy of the U.S. derivatives market through sound regulation. The vision statement: to be the global standard for sound derivatives regulation. And you can see here in their core values, they have clarity, providing transparency to market participants about our rules and processes, not necessarily the market itself. Okay, so the CFTC handles regulation of these futures contracts that come from the COMEX. So now we're going to look at a CFTC commissioner, Bart Chilton. He is a former commissioner, rest in peace, he has passed, but his work has remained more relevant than ever. And just to give you an idea, you can see here that he was an author and a financial, political, and policy writer, a commentator, a speaker, and a consultant. At the Commodity Futures Trading Commission, he headed the Energy and Environmental Advisory Committee and the Global Markets Advisory Committee. So quite a bit of experience, quite high up. He has served on multiple local, federal, and presidential campaigns, Obama's being one, and he's also served in the U.S. House, Senate, and executive branch. So he is a wealth of knowledge, information, and know-how. So let's go right over here from bartsabout.com at bartchilton.com, and we're going to listen to a quick bit of an interview that Mr. Chris Marcus of Arcadia.com, a fantastic presenter, did with Bart Chilton. And we're going to hear a little bit about why futures position limits are important and a little bit about what he saw during his time in the CFTC. And he's going to explain why position limits might be important when regarding futures contracts.
Yeah, and for folks who might be a little bit newer to it, can you explain why the big concentrated position is something that the CFT looks for and is on the watch for to be careful about, and how that impacts the market or has the potential to impact the market?
Well, I mean, if you and I are trading in the futures markets, for a personal account, nobody's going to notice. But if you've got a sizable position and you trade that sizable position, it's one thing if you just have it, but if you're trading it, that all of a sudden 20% of the market goes long or goes short, that can move markets.
Right.
And so that's why there are not what I want with regard to position limits. So that's a whole nother topic of further position limits, but there are some position limits in what is called the spot month. That's the delivery month. That month where you hope everybody doesn't get a pool full of oil. So there are limits in the spot month. There's not limits in what we call the back month. That's every month other than the spot months, or all months combined, which would be the spot month and the back months. Those limits I pushed for, but have not been put in place, even though they're required by law. But those limits can traders that have large positions that are approaching those limits or above those limits or had an exemption from those limits. They are particularly traders that could roil markets with large trades. So it doesn't mean that they're a problem just because they have the positions, but they're certainly suspect. And regulators look at those sorts of things because they can push or pull markets around inappropriately, and that can damage a lot of average folks and a lot of other traders.
So that was from Bart Chilton, a former CFTC commissioner. Again, rest in peace, Bart. Thank you for everything you've done. Where he was describing futures contract position limits with the banks, mainly, is who he was discussing in that interview. He was discussing the position sizes of banks and how a large position size can affect the market. For example, if two large banks go super long in soy, it's going to send the price likely up. If they go super short, or they take out large short positions against corn, it's probably going to go down. And this is where position limits are important with futures contracts. If you're selling far more contracts than you actually have of corn, well, you can see why that might not be a good thing, right? Because we got our visual on what it's for and what a futures contract is. And now Bart is discussing what the contract limits do and why they're important. And as a former CFTC commissioner, he is or was extremely well placed at the time to be making these comments. I want to give a quick, massive shout out to Arcadia Economics, Chris Marcus, for getting this interview in and for doing it very properly, very eloquently. Thank you, Chris. You did a fantastic job. This needs to be mandatory listening for any precious metals or just anybody who wants to know more. Anybody who wants to know more. Thanks again, Chris, and thank you, Bart. So you just heard from the CFTC former Commissioner Bart Chilton about position limits and how when a large trader goes long or short, it can roil or disturb markets, causing market distortions. But now we can go over here to something, to the scholarlycommons.law, and this is a great little resource. And you can see it's part of the Banking and Finance Law Commons. So this is the actual law itself. And this is a review of commodity market manipulation law itself. And I just wanted to read a paragraph here that I thought was important for you guys to hear. So let's just dive into it. Commodities futures trading on the national exchanges has grown spectacularly during the past decade. This increase requires special vigilance against the possibility of attempts to manipulate market prices. While the Commodity Exchange Act, the Act, does not contain a definition of the term manipulation, it nevertheless bristles with provisions dealing with market manipulation of other forms of market disorders. A review of the statutory base dealing with market manipulation and a formative case law on the subject provides a much-needed survey of the murky legal boundaries of manipulative behavior. So that very wordy paragraph could be simplified by just saying that the law as it stands doesn't provide much definitive framework to define manipulation, and so that investigators such as Bart, who regulate that industry, can define it, go after it, stop it, and prevent huge distortions in the market, whether up or down. Maybe some of you are familiar with the GameStop case, when a certain hedge fund went extremely short and sent GME skyrocketing when the Wall Street Bets forum went charging in there. But that's a whole different video for a whole separate time. We're going to stay focused on this. So now we kind of have an understanding of why a futures contract position limit manipulation, or it being too large or anything like that, would be bad, because it could send prices up or down incorrectly compared to the actual physical supply of that commodity. Okay, so we started out by defining what the COMEX is, what a futures contract is, the role of the banks in the COMEX and the futures market industry itself, who regulates that, what someone from that industry thinks about position limits, and he even said in there, if you caught it, that he never got the position limits he wanted, and the fact that there is a review basically talking about the murky legal boundaries of manipulative behavior. And notice they don't say the possible possibilities of manipulative behavior. They just are talking about the fact that it exists in general. Okay, so now what we're going to do is we're going to end this video off by quickly looking at some .gov, justice.gov, from the Department of Justice articles that were released about large banks who defrauded the precious metals futures market. Let's read. JP Morgan Chase & Co. agrees to pay $920 million in connection with schemes to defraud precious metals and U.S. Treasury markets. And if you look right here, it says, the firm has entered into a resolution with the Department of Justice to resolve criminal charges related to two distinct schemes to defraud. The first involving tens of thousands of episodes of unlawful trading in the markets for precious metals futures contracts, and the second involving thousands of episodes of unlawful trading in the markets for U.S. Treasury futures contracts and in the secondary cash market for U.S. Treasury notes and bonds. How that did not earn them a slap with a felony against this bank, I'm uncertain. And if you notice, tens of thousands of episodes of unlawful trading occurred in the precious metals futures contracts exchanges by JP Morgan. So remember that we went back and we listened to the study and reason for banks being involved in providing basically liquidity to the system. But this is what happens when regulators such as BART aren't able, due to murky legal language, to properly rein in market participants who are maybe doing things they probably shouldn't be doing. But don't take just one article, let's do another. This is Deutsche Bank, who is another massive international bank. Agrees to pay over $130 million to resolve Foreign Corrupt Practices Act and fraud case. And I mean, that's not that much to a bank at all. I don't understand how they thought that was going to do anything at all to keep these people from messing around in the precious metals markets, and you can see here that there was a specific scheme to engage in fraudulent and manipulative commodities trading practices involving publicly traded precious metals futures contracts. Again, go back and double check what a futures contract is. Remember that the contract can be made at any time, how the banks are involved, how the regulators don't have much legal recourse, and that's just not a good setup when these banks are massive and $130 million doesn't really do much to them if they're allowed to continue operating. And some homework for you guys is go see, are they barred from operating in the markets? And if they are, why? Well, I just showed you why. So this isn't anything conspiratorial or wild or just made up. This is from www.justice.gov, the United States Department of Justice itself. Two separate articles, and both are not that far back. They are very recent. They are very, very recent. And so now we are going to end here with Ted Butler's bombshell about a bank, Bear Stearns. Do you remember them? All right. Ted Butler bombshell. Gold and silver short positions killed Bear Stearns. Something negative did hit Bear Stearns in the first quarter of 2008, although there are remarkably few details of what went wrong. Since Bear had a significant presence in subprime mortgages and that market was in distress, it is assumed the fall of the firm was mortgage related. That may be true, but there was no general stress in the stock market through mid-March 2008 reflecting a credit crisis. Was there instead some specific trigger behind the company's sudden collapse? I believe that sudden and massive losses and margin calls of more than 2.5 billion on tens of thousands of short COMEX gold and silver futures contracts were the specific triggers that killed Bear Stearns. Let's face it, Bear was so leveraged that a sudden demand of more than 2.5 billion in immediate payment for any reason could have put them under. Bear Stearns' excessive gold and silver shorts on the COMEX are the most plausible reason for sudden demise. And this is Silver Doctors. They do both articles, news, as well as bullion itself. And I have done a separate video on how, where, and why to buy bullion, but I will do a streamlined video again. All right, guys, so I wanted to end with that article because I thought it was important to understand why banks probably shouldn't be getting involved in the futures markets. It should possibly just be the producer and then the manufacturer who really sets the prices for these things and would cause more market efficiency. Okay, guys, well, hopefully I did a good job explaining what the COMEX is from 3 different sources, what a futures contract is from Investopedia, as well as what I hope was a good visual for everybody. And go ahead and check out Harvest Public Media. They have some good stuff. Hopefully that gave you something visual to think back on and say, okay, that's how the futures market works. They're basically just written contracts that can be made at any time for a physical commodity and can be made in mass or to either go long or short something. And as we saw here can really affect things and cause lots of problems. So the role of banks in commodities maybe should be reevaluated more through this lens, perhaps, as opposed to how good they are. And if somebody like Bart, who was a part of the CFTC, had a lot to say about position limits and sizes, and in this specific interview, which you should go watch, had a lot to say about certain banks who may not have been operating properly, as we showed, well, then there's something to be said. And it's very murky legal law about how the COMEX, the primary exchange for the futures contracts on these physical commodities, it's very murky how they should be regulated. And we ended with a couple of official sources of market manipulation being proven out in 2020 and 2021. And we ended with a thought that maybe it was gold and silver short positions that killed Bear Stearns. Maybe that's a fun bit of research to go back and check out. So again, guys, I hope this was educational. I hope you learned about the COMEX. I hope you learned about futures contracts, why the banks say they're involved, and what a CFTC commissioner saw during his time there, and what he feels about position limits and how they can be used to hopefully deter manipulation. But we saw here in a review that it's pretty darn murky and has allowed for this kind of behavior to continue all the way up to 2020. And it was definitely going on all the way back then as well. So all the way back in 2008. So again, guys, I hope it was educational. If you are a Wall Street Silver Forum member, a silverback, and you found this educational, or you didn't, let me know what I can do better. Let me know what you didn't need to hear, what you need to hear more about. Please like, comment, subscribe. If you like this information, I'll continue to put it out. And the more people who like and comment and subscribe and interact with me, the more I know that it's getting out there and people are appreciating the information. All right, guys. Well, this was episode number 11, the COMEX Simplified and Explained. And hopefully it really did a good job just going over a lot of different kind of complex topics and simplifying them down for you. So this has been Devin of Defcon Economics, and I am signing off.